Good morning. Welcome to our regular second Saturday webinar. We will start the presentation. Apart from current market scenario and the recommendations, we may have a technical chart presentation also by Patronabal. First, we will start the current market scenario presentation. So in this presentation, we have both good news and bad news. The good news is that indices has touched a new all-time high. It has broken previous high, which came in October 2021. Both Sensex and Nifty made fresh all-time high in last 2 weeks. But the bad news is that though indices are all-time high, most of the portfolios are still 10%, 15% below all-time high, below their highest level. And even if you see many mutual funds, their NAVs are between 1 to 10% down from their highest level they have achieved. Even some of the funds, if you see, the NAVs are down between 10 to 15% also from their peak NAV level. So most of the portfolios are overall underperforming. But in the last 2 weeks, if you see, broader markets are showing some action. So there are some reasons why the broader markets are underperforming. We will see in coming slides why it is. And the US market, if you see that we are nearing the peak interest rate in current cycle, and in the next 2-3 months, most probably we will see the peak interest rate in US, and after that we may see the pause. In our country, we are almost at the near to the peak interest rate in current rate hike cycle. And the other very interesting thing is that global economy is very weak. If you see their top global economic countries, US, China, most of we are getting negative news from these countries on economic growth front. That also we will see in coming slides, and it will have implications in our economy also. And overall, in the last 1 month, all the indices has given positive returns. Nifty and Sensex marginally up, while Nifty mid cap up by 3%, Nifty small cap up by nearly 2% in the last 1 month. And this is the index chart, Nifty chart. And if you see that in that last October 2021, Nifty touched almost 18,600, which was the highest point at that, which was the highest level at that point of time. Then the market corrected, fell near to 15,300, 400 levels. From there, it has bounced back and has made fresh all-time high in the last 2 weeks. And if you see the newspaper headlines, you can see that markets are at all-time high. Like a lot of bullish headlines we used to see. Actually, what has happened is that from 18,600, market corrected to 15,300 level, and there it bounced back and came to the level what it was 1 year back. So actually, market fell and came back to the level it was seen 1 year back. But news headlines showed that as if market was extremely bullish, and it has been going up on a straight upward movement. Actually, it is not the case. Market fell, again came back what it was to the level where it was 1 year back. That has happened now. From here on, if you get a good rally miss, overall portfolio, if you see on a 2-year basis, it may do well. If you see most of the portfolio on 1 year basis, it is between good portfolios has done around 5% positive on a 1 year basis. And average portfolio were down between 0 to 10% on a 1 year return basis. And majority of the portfolios, if you see, more than 80% of the 80-90% of the portfolios are actually flat on year basis, and they are down also between 0 to 10%. Maybe 10% of portfolio would have given marginally positive return if you take on a 1 year basis. And some of the gainers and losers in the last 1 year, if you see, means where the Nifty at 18,600 1 year back and now, If you see that means there is a big uh, diversion in the market. First, the big outperformer in the current rally is undoubtedly PSU stocks. If you see any PSU stock, be it in oil and gas segment like ONGC, then Coal India, in power stocks, NTPC, Power Grid, and defense stocks, PSU defense stocks, almost railway stocks, almost all PSU stocks has done very well in the current rally. Defense stocks, which consist of PSU and private companies, they have done very well. Adani Group stocks in the last 1 year has done very well, and banks also most of the stocks has done well, except two stocks that we will see in the underperformers. And another big outperformer in the current rally, that is 18,600 Nifty level, at 18,600 Nifty in 2021 and 18,600 in 2022 Nifty level is the ITC. You all know that ITC has a decent weightage in the both Sensex and Nifty, and from 200 to 220 level, ITC has gone up to 340 levels. It has given a very good return, more than 50-60% rally. ITC has seen in the last 1 year, and that has propelled the Nifty. And ITC is one of the biggest outperformer in the current rally. Whereas if you see the underperformers, IT stocks is the biggest underperformer. Even yesterday, most of the IT stocks fell very sharply, as HCL Technology on the investor day told that there are some near-term headwinds in the market. More furloughs are there than expected, and they could able to achieve only the lower end of the guidance they have given, revenue guidance they have given. Like that, they told on investors day, which held in New York yesterday morning Indian time, and that led to sharp fall in IT stocks. Overall, IT stocks were the biggest underperformer in the last 1 year among sectorial indices. Among other shares, high PE shares like Asian Paints and all, they have underperformed. FMCG stocks underperformed. Now they are slowly again bouncing back. And the other biggest underperformers were new gen companies like Paytm, then Car Trade, then Policy Bazaar, Nykaa. All these new gen companies which were listed in the last 1 year, they were one of the biggest wealth destroyers. Most of the stocks were trading far lower than the issue price. They were the biggest underperformers. On banking side, though Bank Nifty is at all-time high, two major component in that, Kotak Bank, HDFC Bank, they underperformed a lot. And if you see Kotak Bank, it is more than 10 to 15% lower than the highest price it has seen, and it is moving sideways. And just 2 years back, if you have asked anyone what you will buy in banking sector, means the unanimous answer was Kotak Bank 2 years back, 2020 and 2021. At that point of time, everyone unanimously bullish on Kotak Bank. 2 years down the line, and they were bearish on PSU banks. 2 years down the line, if you see what has happened, Kotak Bank 10 to 15% down from the peak, whereas all the PSU banks were up by 50 to 100%, and some of them were even up by more. Some of the weaker banks, particularly like IOB, from 10 rupees it has gone to 25 rupees, more than a 150% return. The PSU banks has given in the last 2 years, and that is how the market performs. When there is unanimous bullishness on a stocks, means that everyone holding on it, and most probably that stock may underperform down the line. That used to happen not only in the individual stocks, but also on theme based. Also, it used to happen. It all used to happen on the mutual fund, individual funds also, where peak money, most of the money used to come on the peak performance time, and post that, usually that fund used to underperform. I can give umpteen number of mutual fund examples like that. Even PMS also, if you see, suppose if a fund has is doing very well for the last 3 years, means most of the money will come at the peak performance time, and after that it used to underperform. That used to happen in each and every market time, and each and every style of investing that used to happen. And the perfect example now is the Kotak Bank we can give. And if you see that HDFC Bank also as an underperformer, and when compared to ICICI Bank and Axis Bank and SBI is a big underperformer. So two big banks which has underperformed in the 18,600 Nifty level between 2021 and 18,600 Nifty level in 2022 is the Kotak Bank and HDFC Bank. So these are the underperformers and outperformers at the same point of Nifty, but only the difference is the time 2021 year and 2022 year. So this is the PMI chart of two big economies. We all know that if you table top global economies in the world, the first one is the US with almost 23 trillion economic size. And the second one is the Chinese economy with 17 trillion economic size. And third and fourth are Japan and Germany, around 4 trillion economic size. And fifth one is India, around 3 trillion economic size. And the sixth one is the UK. So if you table the top 6 global economies, among that US and Chinese are first and second with 23 and 17 trillion economic size. And if you see that both these economies have slowed down significantly. So the one of the reliable indicator of how economy is doing is by seeing the manufacturing and services PMI, and PMI is nothing but the purchase managers data. And if you see that any PMI, if PMI data is below 50, means it indicates that economy is in recession. That's what it indicates, the PMI data. They used to take survey among various industries, and they will take the point, and they will arrive the overall PMI data. And above 50 indicates that economy is growing, and below 50 indicates that economy is slowing down and in recession. And if you see the US manufacturing PMI, if you see that it has been continuously coming down. Around April, May, it was around 50, 55 to 60 level. Then in July, August onwards, where the rate hike started. And if you see that gradually it started coming down, and it is now well below 50 US manufacturing PMI data for November month, which indicates that economy is in recession. China, they have their own problem. Till 2 weeks back, they were following this zero COVID policy. That means if there is even a few cases, 5 or 6 cases comes in an area, means they immediately lock down that area, and they will close all the factories, and they will ask people to stay inside the home. Like that, they were following zero COVID policy, and because of that zero COVID policy, there were a lot of lockdowns, individual packets of lockdown throughout China, which has dampened their economy significantly, and Chinese economy has slowed down because of zero COVID policy. The other reason is that in China, one of the biggest contributing sector, real estate. If you see that real estate is also in huge stress. In the last 1 year, we have heard that a lot of big real estate companies in China has faced a massive liquidity crisis. And one company which came in media, which is the Evergrande, a few months back, Evergrande, which is the second largest real estate company, was in deep stress, and they were almost on the stage of bankruptcy. Their bond prices and all fell very sharply, indicating that company may go for bankruptcy. So, but because of very weak real estate sector as well as zero COVID policy, Chinese economy is in deep trouble. And if you see the PMI, manufacturing PMI, and if you see that for the last 4 months continuously, the PMI data is below 50, which is indicating there is contraction in manufacturing activities in China. So both big economies, US and China, they are having problem, which is clearly shown in their PMI data, which is well below 50. And the third and fourth, if you see Japan and Germany, Japan actually no one is taking into account because of their very high age population, as well as stagnant economy. Japan, no one is considering as a big economy nowadays. The fourth one is the Germany. We all know that due to the Russia-Ukraine war, energy prices has gone up very sharply in Germany, which has affected their economy. So among top four economies, everyone is facing some sort of problem. The fifth one is India. India is doing reasonably well when compared to the top four economies. And if you see the Indian exports, whenever the global economy slows down, it will get reflected. It will get reflected in our exports data also. And if you see that exports has come down very sharply, very sharply in the last 6-7 months. At one point of time, exports was almost $42 billion. Monthly exports were around $42 billion. Now, the latest data came to 30 billion. Almost 30% contraction in exports has happened because of weak global economy. And one very reliable data which everyone can see how exports are doing is by seeing the exports of our two-wheeler companies. So we have 4 two-wheeler companies which are listed, which is the Hero Moto, Bajaj Auto, Eicher Motor, and TVS Motor. All the 4 companies will give every month. They will give on first of every month. They will give their monthly sales data, how much vehicle they have sold, and in that we can see how much exports of two-wheeler they are making. That data also these 4 company will disclose on every first of month. And if you see that in the last 3-4 months, exports are continuously falling for all these companies. So that clearly indicates that a global economy is somewhat in stress, and India is no exception. And we will also face some export slowdown. The main sector which will get affected because of global slowdown is the textile sector. Textile last year did phenomenally well, mainly because of a huge demand increase from Europe and US. Now, if you see that majority of the spinning mill companies, they are operating at only 50% capacity because there is no demand for that, new demand for their products in exports market. And cotton price also went up very sharply last year. In the last 2 months, cotton prices has come down. For 2 years back, cotton prices were around 60,000 rupees per candy. It was trading around 60,000 rupees per candy. It went up to 1 lakh. Now again it has corrected to 65 level. It has corrected cotton prices. And during the sharp increase in prices, there was huge demand. But when prices went beyond a certain limit, export demand collapsed a lot. And from Europe and US, there is not much demand, and there is huge inventory also lying there. And because of that, most of the spinning mill companies, they are operating only at 50%, 60% of their capacity, and balance capacity are lying idle. It is expected that next 3 months the situation won't change. Only from April onwards, gradually demand will again come back because of fall in cotton prices, which means that price will of cotton yarn also will come down. And if you see that in Tirupur and Coimbatore region, which is the textile hub of South India, a majority of the mills are running at very low capacity. So exports demand is very less. So the only way India can do well is by propping up the domestic economy. And now markets are betting on the capex cycle recovery. See, markets need some points to justify rally in certain stocks. And since global economy is doing well, not doing well, we are seeing that IT sector, which directly depends upon the US and the European economy, they are facing some near-term headwinds. They are facing, even though still the demand is robust, but it is not as robust as what it was seen 1 year back or 6-7 months back. Some slowdown has come in. So IT sector, is the one which immediately get affected if there is a sharp slowdown or recession in US and Europe. And the second sector are the textile sector and other engineering goods, gems and jewelry sector that will get affected. Shrimp also got affected because of lower demand in US. So a lot of export oriented sector got affected. That is why now market is betting on the domestic economy, and that too on the capex recovery, capex cycle recovery theme. Market is betting on, and if you see that even though market hasn't, even though many stocks did well, some of the capex driven sectors like L&T, Cummins, they have done very well. Even yesterday, L&T touched their new all-time high, but because of late day correction, the stock price fell a little bit. But still, L&T is showing tremendous strength among Nifty stocks. Similarly, stocks like Cummins, which are basically on the capex cycle driven, they are doing well. So now market is majorly betting on capex cycle recovery. The basic point what they are analysts are justifying this that a capex cycle will happen in next 2 years is that the central government has announced the PLI scheme in the last 2 year, which is the production linked scheme, which is mainly aimed at import replacement and export boosting, where you will, if you put a plant which can replace import, or it is done for export means that capex will get some incentive they will get on taxation front from the government. That is what called production linked incentive scheme, and most of the companies are opted for PLI schemes in companies like Dixon Technology. Almost in all sector, most of the companies has opted for this PLI scheme. So they will spend a lot of money on putting up their factory, and they will start producing, and that may lift the capex. The second one, what they are telling is the China plus one strategy, where many of the European and US customers were adopting. That means some of the big companies like Walmart and all, they were buying many products just from one location, just from one country, from China. They want to de-risk the locational import, and that is why they want to diversify from China to other countries. For example, textiles, they want to diversify from China to countries like India, Vietnam, and Bangladesh, Pakistan. Like that, they want to diversify it, and because of that, India may see some demand because of this China plus one strategy, and that may boost the new investment in certain sectors. And a China plus one strategy is not a 1 year, 2 year thing. I feel it is a 5 year to 10 year thing, because China has huge market share in many of the products in the export market. India actually exports around 30 to 40 billion per month, whereas China exports around 300 billion worth of goods per month. Almost 8 to 10 times the export market is higher than India. And even to replace 10% of Chinese export market means it is almost equal to 100% of India's exports. So it is not a 1 year or 2 year theme. It is a 5 to 10 year theme. This China plus one strategy to be adopted by European and large European and US customers. And India will definitely benefit from that, even though 100% it is not going to get replaced from India. India may not benefit 100%, but definitely a part of it will come to India. Pharmaceuticals may come to India, textiles may come to India, but definitely say a 5 year plus 5 plus year benefit India is going to see from China plus one strategy. And the third one market is betting on is the renewable energy investment, which is particularly solar. So a lot of companies are investing in the solar energy and to a certain extent wind energy. and that will create a big capex opportunity for the Indian companies for installing that, and that is also will boost higher capex in our higher capex cycle. And some of the smaller themes like ethanol plant, putting up of ethanol plant due to government policy, that also will boost the capex cycle. So overall PLI scheme, China plus one strategy, renewable energy investment, and other power sector investment are leading to higher capex by corporate. And most of the companies have already lined up their plan for big investment. And if you see on the next year, definitely we will see on the ground level the capex cycle kicking on. Because private sector will start doing lot of capex, and government, I am expecting huge spending will happen next year, just because next year by 2024 election is going to come, and if you spend next year only, it will be visible among publics, so that it will turn into a positive factor for the ruling government. So next year I am expecting a lot of spending by the government. So next year public and private capex will be good enough to propel the economy. even though the export markets are weak. And this is one interesting chart. And if you see the capex announcements by the private sector, it is well above 53% from the pre-COVID era. And if you see that almost 8.5 lakh crore new capex has been announced by the private sector. This is actually just the announcement. The actual spending may take some time. It is not going to come immediately, because it is just the announcement. But private companies have lined up their capex because for some of the reasons I told before, like PLI schemes and renewable energy investments and China plus one strategy. And the private sectors have lined up huge investments. And if you see the announcement, it is far higher than what it was in pre-COVID area. Whereas the government, still it is lagging. No major announcements has been made by the government, but they are actually spending the old announcements. They have already said no, but government is spending a lot of money on that I will show in next slide, where they are mainly spending. Whereas new announcements, there is no major new announcements by the government in the last 7 months, 8 months. But I expect that next year we may see lot of announcements by the government side also. Right now, private sector have announced huge capex in coming years. And this is the government capital expenditure. And if you see that between last year and this year, in the first half, government have spent a lot of money in road transport and highways. If you see, almost 65% increase is there. Railways, almost 90% increase in spending by the government. And if you see that most of the railway stocks are doing very well. Defense, there is not much increase in the capex. Food and distribution, these and all small head. The major head is the road transport, highways, and the railways and defense. Among the three, road transport or highways has seen huge increase in the spending, and railways almost double from 46 crores last year. In the current first half, government has spent almost 88,000 crores. So huge money is being spent on railways. Government is planning to launch more projects in railways. Vande Madara train, where they want to increase multiple routes that train. So government is spending a lot, but new announcement is missing, and I am expecting more announcement will come by next year. And RBI has hiked repo rate. 2 days back, they have hiked the repo rate again. And if you see that by 35 basis point, they have hiked it, and it is almost in line with the consensus. So from 4% during the COVID time of repo rate, they have hiked to 6.25. over multiple times they have hiked it. Almost 2.25% interest rate they have hiked it from 4 to 6.25. And what we are expecting is that from here on, most probably RBI may pass. Very unlikely RBI to hike interest rate from here on. Maximum at most another 0.25% they may increase. But my personal feeling is that most probably RBI will pass interest rate at 6.25, and they will wait for 3 to 6 months, and then they will take the decision either to reduce the repo rate or increase the interest rate. After 6 months only they will take the decision. Most probably the interest rate hike in the current cycle has neared the peak from 4 to 6.25. It is almost near to pre-COVID level where we have seen it, but still when you compare to 5-year, 10-year back, the interest rate are still lower. And this is the point which I want to tell on interest rate. Interest rate near peak in current rate hike cycle, and most probably RBI will pass from here on. And monetary policy committee, they are the one which takes the interest rate direction, and they most probably wait for data for at least 3 to 6 months and for making further changes. So they mainly focus on what will be the inflation, and from there on they may take whether to hike or reduce the interest rate. They may wait for 3 to 6 months. And the other important thing is that the banks, they have not yet fully passed the interest rate hikes to both depositors as well as the those who take loan. Only around 50% interest rate hike by the RBI has been transmitted to the borrowers. For depositors, even 50% is not even passed on to the depositors. Deposit rate hike is still less than 1% for many banks. For borrowers, almost near to 1% they have hiked it, and another 1% they may hike it gradually in coming days by banks. And almost the EMI, because of the current rate hike cycle from 4 to 6.5, 15 to 20% increase in EMI is expected for the borrowers. One positive point why RBI will pass the interest rate hike is the Brent crude oil prices. If you see the Brent crude oil prices, it is at the pre-war level, $76.8. During wartime, it went up to $130. Then it was hovering around 80, 90 to $120. Then it fell. Now it has come well below the situation when the war was started. Actually, war started during February 2021. At that time, crude oil went above $85. From that base level 85, it went up to 130 level, and now it has corrected to pre-war level of $76. Global countries, they have placed an $60 price cap for the Russian crude, and Russia says that it is unacceptable to them, and they are going to reduce production. And what big economists want is that they want crude oil prices to fall to $60. That's why they have placed a cap to Russian exports at $60 per barrel. And now already price has fallen very sharply in the last 3-4 weeks, and it has come to 76 level, and it is positive for our country. For India, $60 is an affordable price for our India, for our economy. Even though Russia has given a discount, still the crude oil prices are elevated for our economy to absorb. And I expect that if crude oil falls to $60, then it will be positive for our economy. Inflation also will gradually come down. Credit growth remain very, very strong, and because of this reason, and if you see that credit growth is almost 17%, 16 to 17% credit growth is there. And if you see that it fell just 5% during COVID time, and previously in December 17-18 time it was 15, and then 12-13 time 12-13 December, during December 12 to December 2013, it is 16. It was around 17%. So now it has come to near to that level, and I expect that the credit level, credit growth will remain at the elevated level, and it will be positive for the banks, because higher credit growth means it is like more business for the banks, and higher capacity utilization. When you compare to a manufacturing company, credit growth, you can compare it as a higher capacity utilization, because the deposit growth is not to the extent of credit growth, which means that banks are utilizing more cash for higher interest rate, and that may boost the profitability of the bank. And banks unanimously, except Kotak and HDFC Bank, most of the bank has rallied very sharply because of two reasons. One is that credit growth is very strong. The second reason is the provisions, peak provisions are behind the banks. That means from here, in near term, the provisions will remain at very low level, and which will increase the profitability of the banks. But one has to be very careful on buying the weaker banks. On PSU banks, we are positive only on the SBI, and to some extent Bank of Baroda and Canara Bank. Beyond these three banks, it is very risky to buy other PSU banks, because all the other banks, they have their own issues on technology front and client acquisition front. They have their own issues. So if you want to stick to banks as an investor, means you better stick with the SBI, Bank of Baroda and Canara Bank. All other PSU banks, for trading purpose you can do it, but better avoid it as an investment category. Q2 results, already we discussed a lot during the previous meeting, during November meeting. And if you see the companies which came in Q2 results, almost all companies came out with the results. And a very interesting fact in that is that half of the company has delivered good results, and half of the company has missed the expectation exactly in all categories. Nifty, if you see that out of 50 companies, 21 companies managed to come out with results better than expected, and 17 companies missed the expectation, and 12 companies almost came in line with the expectation. So it is a mixed bag. The results came. Company came better than expected, they have done well, whereas the company which came missed the estimates, they have done badly. Similarly, if you take Nifty next to 50, only 12 companies managed to deliver better results, whereas 26 companies, half of the company failed in meeting expectation. And mid cap 100, if you see, 41, exactly half of the company delivered good results, whereas another half missed their expectations. Nifty small cap, 24 companies managed to deliver good results, whereas 35 companies disappointed, 9 were neutral. So half of the companies failed to deliver good results on index-based companies. This is Nifty next to 50, Nifty mid cap 100, then small cap. So half of the companies missed the results. That is why if you see that even though index has gone up, majority of the companies did not participate in the current rally because of the missing the expectation. One of the reason why most of the companies missed the expectation is the sharp increase in the raw material prices. Crude oil prices went up a lot, power cost went up a lot, and then raw material prices, packaging, paper prices went up a lot, many chemical prices went up a lot, steel prices went up, and because of sharp increase in the raw material cost, as well as the higher interest expense due to higher working capital, most of the companies missed the estimates. And next quarter, that is not Q3, Q4 results, which will come in the April, May, that may give little better numbers on margin front, because commodity prices have started correcting, and other thing is that many of the companies have increased the prices also. So the margin pressure which they faced in the last 2-3 quarters, that may start seeing on positive front from Q4 onwards, not in Q3. From Q4 onwards, on margin front, we may start seeing positive impact. The other thing which surprised me a lot is the performance of the steel companies, stock wise performance of the steel companies. In Q2, majority of the steel companies posted very poor results. Tata Steel profitability fell by 90%. From 10,000 crores profit came just 1,000 crores. Sale from big profit, they showed losses. Similarly, JSW Steel profit fell very sharply. From big profits, the results was extremely bad. But in spite of very poor results, the stock prices did not fell much, in line with the very poor Q2 results. Moreover, if you see the Chinese economy is doing very poorly, whenever Chinese economy does badly means generally commodity stocks used to do very badly, because China is the biggest consumer of the all major commodities. If you take ferrous as well as non-ferrous base metals, if you take, but in spite of very weak Chinese economy, the stock share price of many steel companies and the commodity stocks are still holding on, and weak Chinese economy did not trigger very negative sentiment on these stocks. So one positive which has happened between pre-COVID and now is that most of the commodity companies' balance sheet are extremely strong now. If you take Tata Steel, they reduced their debt by around 30,000-40,000 crores. They have reduced it at one point of time, pre-COVID level. Tata Steel debt was 1 lakh crore. Now they have reduced it to less than around 70,000 crores. Sale, they have massively deleveraged their balance sheet. So that is one positive which has happened because of bumper profit they have made during the COVID time. They utilized it to reduce the debt. Now, what is happening in a corporate side is that, especially in commodity side, is that most of the companies, they are focusing on price. If you see 10 years back, 20 years, 30 years back, most of the companies, commodity companies, they focus on only volume growth. They don't take care on the profitability previously. They want to build the capacity, they want to sell more items. But the situation has changed completely in the last 4-5 years, where the companies, big corporates, they are mainly focusing on profitability rather than volume growth. That first started happening in cement sector, where almost a silent cartel was created. In spite of whether big demand is there or very weak demand is there, they do not reduce the prices, because all companies get together and form a cartel, and they don't reduce the prices beyond certain point, even if demand is very weak. Now that is happening in other sectors also, and the latest one is the steel. In spite of weak demand and very weak global prices, the domestic steel companies did not reduce the prices beyond certain levels. Previously, historically, what used to happen when global steel prices fall very sharply, domestic steel companies used to drop steel price in line with the global prices. Now, in spite of weak demand as well as export tax, domestic steel companies did not reduce the steel prices beyond a point. Now domestic steel prices are far higher than international prices, and some companies even started importing steel, because steel prices are lower globally. But many companies still prefer to buy domestically, because importing it has its own negativity. That time lag is there for receiving the steel imported, as well as some quality issues will be there, and forex risks are there, and because of that they prefer to buy domestically even though prices are higher. So now the big sentiment which is focusing on corporates are that that they are focusing mainly on price and profitability rather than to show higher volume. Instead, they are happy to put the plant ideal. Just now we are seeing no in a spinning mills. Most of the spinning mills are running at 50% capacity only. But if you see 10 years, 20 years back, if price falls, means even at lower price, they will try to run at 180 to 90%. They will try to run the mill and they will show higher losses. But now they are not interested in running the mill at a higher capacity utilization to show loss. Instead, they want to reduce the loss, but they want to reduce the production also. And they are very happy by running the mill at a lower capacity. The same thing is happening in almost all sectors. And valuation front, if you see that Nifty has come to the a higher level now at a all-time near to all-time high and near to 1 year back what it was that. And if you see the valuation, the Nifty P is at a elevated level, 22.24 now. The Nifty P ratio is, even though it looks little lower what we have seen previously. If you see that previously before March 2021, if you see that Nifty has traded around 26, 27 level. And in previously also in 2008 also Nifty has traded around 27, 28 level. And in 2012 also Nifty has traded around 20 more than 25 PE. But that P ratio and current P ratio has one major differences there, because during those time before March 2021, Nifty P ratio is calculated based on standalone earnings, whereas now Nifty P ratio is calculated on consolidated earnings. That means the 2022 PE now is almost equivalent to 25 PE what it was shown before March 2021 level, because the current PE is on consolidated level, but whereas whatever the other PE which you see historical PE, it is based on standalone. So almost 10 to 15% difference is there on that. Consolidated PE will be always be lower because consolidated earnings of company is it's always be higher. So now if you want to compare apple to apple or orange to orange, means Nifty is almost around now 25, 26 PE level, which is slightly on the higher end of the band. That is why some of the companies, some of the mutual funds, if you see like ICICI, Prudential Debt and Equity and Debt Fund, where they churn the equity percentage and debt percentage based on the PE level, they have reduced lot of exposure in equity. If you see ICICI Prudential Balanced Fund, where they invest in line with the PE ratio. If PE is high, means they will reduce exposure to equity component, and if PE is less, means they will increase the equity component. Like that fund operates, ICICI Prudential Balanced Advantage Fund. And if you see that they have reduced the equity component substantially lower because of a very high PE we are seeing. And this is the point which I was making previously. Nifty PE is calculated on consolidated earnings with effect from April 2021 onwards. Nifty is before that all the data are standalone. So now the current consolidated PE ratio to 15% higher than the actual data we see now. If you want to compare on a pre-April 2021 basis. The other interesting thing which is happening, why the PE ratio is increasing higher and higher, is that more overvalued stocks are getting added in index now. Now recently what has happened is that Adani Enterprise is added in the Nifty recently. It used to trade at much higher valuation when compared to the stock which was removed. So if you keep on adding higher overvalued stocks with higher PE in the index, which naturally the overall Nifty PE ratio will be higher. Many of them may tell that Adani Enterprise has very less weightage. It won't. It doesn't matter in the Nifty PE. But still, it will add some weightage to the Nifty higher PE, higher Nifty PE level. And because of addition of overvalued stocks, the Nifty PE index, overall index PE has gone up. The other important thing also has to be seen is that the PE should be seen in context with interest rates. PE ratio and interest rates are inversely proportionate, and if interest rates are high means PE ratio should be lower. And one of the reason market analysts were giving for very high justification for very high PE ratio stock just 1 year back, 2 years back was that interest rates are very low, so we can give very high PE ratio. Like that, many of the analysts were giving justification 1 year back when stocks were trading at 80 PE, 90 PE, and many loss-making companies were justified based on very low interest rates. But now interest rate has gone up, so theoretically the PE ratio should have come down now because of high interest rates. PE ratio should have come down, but actually if you see that the PE ratio has gone up along with interest rates, and a higher interest rate may dampen the valuations in coming days. And that is one of the reason why the newly listed stock has done very badly, companies like Paytm and Policy Bazaar, because the interest rates has gone up very sharply, not only in India, globally, which means that the cost of money has gone up, which means that the valuation PE ratio should come down to justify the stock price. And this is the S&P BSE PSU index. And after many years, the stock PSU index has come near to the peak. And if you see that many of them have missed the rally, and for a simple reason that many funds, they proudly come in TV and say that they won't touch the PSU stocks, and they say many reasons why they are not buying the PSU stocks, and most of them have missed the rally in the PSU stocks, which has happened in the last 1 year. And PSU stocks across the board has done well. Defense theme, railway theme, oil and gas theme, and divestment theme, and many stocks has done very well. And it is near to the peak level we have seen historically. And this is the US 10-year bond yield. It has corrected a little bit from 4.3 level. Now it has come to 3.5 level. And we expect that most probably the index interest rate hike cycle will come to an end by March. Still 3 more small hikes are left. And December 14th meeting, that is next week, US Fed meeting is scheduled, and we are expecting 50 basis point hike. The last 4 rate hike meeting, US Fed meeting, 75 basis point has been hiked. From December, we are expecting 50 basis point hike, and in February 2nd and in March, most probably 25 basis point hike may come. And from that, the interest rate hike may come to an end in the current rate hike cycle. FII activity, they are not selling much. Most of the selling came till July only. After that, there is not major selling. And if you see that figure, that till date, it has come to minus 2.4 billion. At one point of time, it was a big negative. Now it has come to minus 2.4 billion. Mutual fund flows. Yesterday, the data came. It was very less. One of the reason for that, the newspaper flashing the news of index all-time high, that has made many of them to redeem their money. Generally, if you see that Indian domestic investors, they tend to invest at the lower level when market is falling. At the high point, they tend to withdraw, and that has happened now also because of index making a new high, and most of them have redeemed their money from the mutual fund. Even though SIP monthly SIP is around 13,000 crore. The net inflow is 2,200 crore only, indicating that almost 11,000 crore lump sum has been withdrawn from the mutual fund, equity mutual funds. So it is one of the lowest inflows we have seen for the last 2 years. So before that, only November 2019, that inflow is there. But certain period of time, there was some negative inflow was there. After that, again, market went up. So what we are expecting is that its market is going to be divergent. It is not going to be across the board rally. Now the crude oil prices are coming down. A new set of stocks may go up because of the companies which are going to be benefit from the lower crude oil prices. That may see some positivity, and stocks like overvalued stocks and stocks which has done very well in the last 2 years, 3 years, they may underperform. So overall, it is going to be the stock pickers market. It is not going to be the broad-based rally we are going to see, and it's going to be stock pickers market in the next few months. That is what I'm expecting. Now it is not going to be across the board rally. And events to watch, geopolitical developments we have to see. Then we have to see the pre-budget rally. February 1st is the budget, and I am expecting good budget action coming on from a budget activity, a pre-budget activity happening in the market. I don't expect sharp fall in the market in the month of December. Yesterday, we had some correction in the broader market as well as in the index. What I am expecting is that historically December don't used to fall a lot. It will used to be range bound, and that is what I am expecting in the very near term. In January, I am expecting a good movement in the market based on the pre-budget expectation. So that's all the current presentation, and we will see the recommendations now. So these are the stocks which I am recommending this time. The first one which we are recommending is the Bank of Baroda. I feel the banking stock still has some more steam left, and in PSU banks, we are very positive on SBI, and many times I have recommended the State Bank of India stock in the presentation. And suppose somebody wants to buy a PSU banks, means better stick only with 3 banks: SBI, Bank of Baroda, and Canara Bank for investment view. For traders, the other stocks are the better one because they have very sharp up and down move, and they can consider investing in Indian Bank or Union Bank or others for trading purpose. UCO Bank for trading purpose. For investment, we stick only with the 3 banks: SBI, Bank of Baroda, and Canara Bank. And this time, I'm recommending Bank of Baroda, and they have reduced their NPA a lot, and I'm expecting they will do well. The second stock I am recommending is GSFC. Previously also I have recommended many times this GSFC. They have basically have 2 divisions. One is the fertilizer. The second one is the chemical division. Caprolactam they are manufacturing, and other chemicals also they manufacture it. What has happened in the last 6 months is that fertilizer division has done exceedingly well. They have made huge profit in fertilizer division, whereas the chemical division has done very badly, and most probably in Q3 also the chemical division will not do well because there has been sharp fall in many chemicals prices for GSFC manufacturers, and that may lead to very poor chemical division performance. But on a consolidated basis, GSFC overall will do very well, and I am expecting this current year FY23 they will show huge profitability if in the current year on a consolidated basis of both chemical and fertilizer division. And valuation wise, if you see, they are one of the cheapest fertilizer as well as chemical stock. Actually, GSFC was once an index stock in 1980s and 80s. It was an index stock at that point of time, but due to the inherent nature of that business, it could not able to grow well, and it came out of the index. And if you see on valuation front, it still is exceedingly cheap. If their book value is around near to 290 rupees, whereas the current price is not even half of that. Similarly, current year they will show around 30 rupees EPS. They will show. That's what I'm expecting. Trading around 3 to 4 PE. It is trading, and I expect some movement in the fertilizer stock before budget, and I'm recommending. That is why I'm recommending this GSFC share. The third one is the other thing is that they don't have any debt. GSFC has a very strong balance sheet. They don't have any debt. So somebody wants to buy a company with a reasonable with a decent fundamentals with a reasonable valuation, means they can consider this GSFC. The third one we are recommending JK Cement. I expect because of the capex cycle recovery, as well as real estate doing expected to do well. The overall cement as a basket will do well, and the last 6 months, because of very high coal prices, most of the cement companies did very badly. Now the coal prices have started coming down, which will boost their profitability. And among mid cap, JK Cement is one bet. Last time I gave Dalmia Bharat Cement, and that has done well. The fourth stock, Rallies, we are recommending. Many times we have recommended in the past, and it has disappointed a lot. But I feel the worst is over. The company is on the verge of completing their 500 crore capex in current year, and the last 3 years, current year, last year, and before that year, almost Rallies has done almost 500 crore capex. In current year, they are expected to do 250 crore capex, and previous year and before that, almost 250 crore capex they have done it. So overall, in the last 3 years, almost 500-600 crore company has done has done and will complete capex in the current year, and that will start showing their growth in coming years for the next 2-3 years. And moreover, the Rabi crop is very strong. As on yesterday, 15% increase in their overall acreage is there on Rabi crop, which will benefit companies like Rallies. And I expect from the third quarter onwards, the company will show very good performance when compared to previous year. And downward risk is also very less. And it is a Tata Group company. Tata Chemical is the promoter for the company. I feel the worst is over for that company, and from here on, company will do well. And somebody who is folding this share and bought at higher price based on our previous recommendation, they can very well average this stock, Rallies India. I expect in next 1 to 2 years, it will give very good returns. The fifth one I am recommending is the Exide. If you see the Exide, it has done very badly in the last 10 years. The stock has given 0% return in the last 10 years. And they have sold their Exide insurance to HDFC Life. And they have, in return, they have got the shares of the HDFC Life. I expect that Exide at some point of time in future, they will completely sell the HDFC Life shares. And that money will be used for future companies development in lithium ion category. And lead acid also doing reasonably well. And overall, I expect the company to do well. So these are the 5 stocks I'm recommending. And in October review, if you see that one stock which done very badly was the HCL Tech. Actually, most of the fall came yesterday only. Yesterday, it fell by almost 7%. It fell. HCL Tech stock fell by 7%, and that has pushed that stock into negative return in this because of the investor day comment they made it yesterday. The stock fell, and I expect that HCL Tech will do reasonably well in the next 2 years. So one can safely fall down and can add also some shares. Moreover, it's a good dividend yield stock, and in every quarter the company will give dividend. The other stock is the L&T. It has given very reasonable returns. L&T 7% return it has given till yesterday, and I expect that for the next 3-4 months L&T will do well. Dalmia Bharat done very well, almost a 12% return it has given. Wonderla also has done reasonably well. It went up to 3. We gave a target of 400, but the stock price went up to 398, and it has done reasonably well. Akzo Nobel, one can fold for long term. Now the crude oil prices are coming down, and I expect that the stock will do well as raw material prices started falling. So overall, 3% return is there. A small negative return from HCL Tech because of yesterday's fall. So overall, it's a recommendations. Last month recommendations has done reasonably well.